Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson. Today, alongside Tom McKenzie and Lizzie Burden, we're around an hour away from the start of trading here in Europe. So what do you need to know? Industrial action. Germany struggles to get its machines moving. We're going to have the latest numbers from a host of manufacturing giants, including BMW, Henkel, Siemens Energy, and we're going to be joined by the Continental CFO. Does the recovery come in the second half? We're 90 minutes away from finding out if Sweden's Riksbank is going to cut rates. Two-thirds of economists expect a cut, but the krona's recent rally could be the casualty. We'll talk about that. Plus, as Israel edges further into Rafah, the US pauses shipments of bombs as the Biden administration worries about significant civilian casualties. We'll have the latest on that story as well, Tom.
Markets today then, checking in on the market moves right now. 4 straight days of gains for the S&P, even as it was a challenge session. Gains of just 0.1% for the main index stateside, of course. Looking, it seems, these markets for an additional catalyst. European futures pointing to losses of 0.1% as the earnings story is tied in to the action here. The FTSE 100 continuing its relative outperformance, looking to add 0.2%. The US 10-year, after that auction yesterday by the Treasury, relatively well received. 446 currently on the benchmark. Euro dollar at 107, down 0.1%. Markets today starts right now.
Wednesday, the 8th of May. Good morning. Something of a theme running through the show today, and that is the German industrial story. We get data. This is data that dates back to March, but nevertheless, I think is interesting because it tells two stories. And we're also got a lot of corporate news that we need to be digesting as well. So the industrial production, this is seasonally adjusted. This is month on month, negative 0.4. Now, that's down from 2.1, which has actually been revised lower. The prior number revised lower to 1.7. But the current data actually maybe not as bad, as bleak as maybe some people had been anticipating. But it does speak to a story of a first half for the German industrial machine that has been much more difficult than anticipated. But we continue to hear, and Tom, you've been speaking to a bunch of German industrials this morning. We're going to speak to the Conti CFO a little bit later on. They're all talking about a better second half. And we've heard this from Mercedes, we've heard this from Daimler Trucks. We're hearing it from a whole host of German industrial giants. Does that get delivered upon, and is it dependent on rate cuts from the ECB? Yeah,
that's really interesting. If you think about the ECB is going to go in June. So we were speaking to Siemens Energy. They have their own idiosyncratic story around challenges with particular turbines and the Gamesa unit. But as you say, they did raise their forecast for the full year. They are starting to see that demand coming back. The order book is looking pretty solid. Is that on the expectation, or are these industrials now, these conglomerates, are they able to better manage this higher rate regime? Are they really making these forecasts based on expectations that rates are going lower, or is this a more resilient relative economy that we're looking at? They are also streamlining as well their operations.
It's interesting because the consumer starting to come back in Europe. The consumer's starting to feel a little bit better in Europe. The industrial story yet to kind of really feel that kind of feel-good factor. Does it come next year? But Lizzie, is it dependent on these central banks cutting rates? Because Kashkari last night was sounding like he's not really ready to go in the United States. How far ahead is Europe prepared to run?
Yeah, Kashkari, unsurprisingly hawkish, though. We've had all the positive vibes coming out of Milk, and I think we can put that to one side. When we think about Europe, though, think about the difference between the industrial story and the services story. It's much more positive on the services front. So there's a bit of your hope for Europe in terms of the economy. We've had the Puma results as well. Actually, they see 620 million to 700 million euros for full-year EBIT. The estimate was for 656 million. So pretty much in line, actually. I think it's interesting when you think about the Paris Olympics coming up, Guy.
Lizzie has things to say about Puma.
I like this.
We're just going to sit back here.
Look, I'm not a sneakerhead guy, but I am going to say this is an opportunity, right?
Okay.
Because you can put your effort into making proper trainers again. This is where the margin is.
Proper train.
Proper trainers. Guy's got his high tops on today.
I've got my Manolos on.
There we go. The Manolos, the high tops. I'm not going to compete in the shoe contest. The Olympics is an interesting story, though, actually, in terms of the catalyst that it could, across a number of retail space, the branding, the big names, of course, getting behind that, starting across, focus on Paris, but across France, of course, later this year.
That could be a consumer boost.
That could be a consumer boost at a time when the consumer is looking relative resilience. On the Puma lines, then, Lizzie touching on a few of them. Again, in terms of the gross profit, close to €1 billion. In terms of the sales coming in at 2.1 billion euros, 2.1 billion euros coming through in the first quarter. Top line is, first quarter, Puma beating net income estimates marginally. Not a blowout set of results, but a modest beat coming through from Puma, suggesting again that consumers out there are still willing to snap up some of these products at something of an extent. We'll see again if the Olympics gives that more of a boost, Lizzie.
Yeah, we've got the football as well, perhaps more up your alley. I know you're a rugby person, guy.
I've never had my footwear scrutinised quite so closely. This is usually something. Sambas have been doing well for Adidas. I do know that.
Not since Rishi.
Not since Rishi wore them. No, maybe that is that's a tough one. Look, I think the bigger picture here is that we have this kind of sequential story that is developing in Europe, and I think it's going to be really interesting to see how that plays out. Consumer first. Are we going to see the industrial machine kicking back in at some point later? How dependent is that on China as well? It's been really interesting to monitor exactly what Xi Jinping's been saying, and that relationship remains critical as well to Europe. So Europe you can see the ingredients being there for a recovery. The China machine starts getting going. That helps the German machine, the Swedish machine. You get a rate cut story that's beginning to gain a little bit of traction as well. Is that something that is going to provide? And I hear it from company after company, from company to company now. They're expecting this second half recovery. But how fragile is that recovery, I think, is a question that I think everybody's still grappling with. And if the central banks don't deliver, is it going to fall apart?
So central bank cuts, China potentially in terms of the growth picture there, and a relatively resilient job market as well. The job market, the labour market in Europe has not cracked. And are these more match-fit companies now, given everything they've gone through, given their focus on trying to deleverage, given the cost-cutting that's come through from many of these companies? Are they more match-fit in a more benign environment?
So I hear what you're saying. But the labour market is super strong. And you look at the labour data, you look at the wage data that's coming out of the UK at the moment. I think that's a real struggle for the Bank of England as well. I think it's having to deal with that. You listen to what Conti has to say this morning. What is it dealing with? It's dealing with really high wage inflation. That cost story is where the real challenge is. Because at the moment, they're dealing with the auto sector. They're dealing with a slowing market, but at the same time, their labour costs are still incredibly elevated.
And certainly when you think about the Bank of England decision tomorrow, yes, there's a triumvirate at the hawkish end, the green maskell man triumvirate that's thinking about that labour market data, the services data, yes. But you've got other data that's much more encouraging. The idea that inflation could be back at target this summer. Could that mean that you get Dove's joining Swati Dingra, the likes of Dave Ramsden, actually pulling the BOE more towards cuts?
Lizzie's very excited about the Bank of England for tomorrow. Yeah.
Well, the excitement is real, right? There's real debate. I'm not going to pour cold water on Lizzie Burden's BOE excitement. Will they, won't they? Can they diverge from the Fed? Back to the corporate story for the moment then, and the German story in particular. And we're going to be speaking to the executive from Continental. Just the top lines coming through. And Guy, absolutely right to scrutinise what's happening in terms of the cost component and labour, of course. We'll be putting those questions to the CFO. They have confirmed, Continental, their full-year outlook. Of course, a company that surprised a lot of these components, not just tyres, to the autos market. Sales coming in just shy of €10 billion, but confirming their full-year outlook. Is that relative optimism around, or at least the ability to confirm that full-year outlook, ties back to your point, which is, will it be a more benign environment and that will be comfortably met, or are they stretching things a bit?
I think that it's the second half recovery. They're all pointing to it. Is it actually going to end up materialising, and what is going to be the catalyst for it? There's a couple of other things I want to flag this morning, one of which is we've seen a soggy auction in Japan. I wonder whether that bleeds into the auction a little bit later on in the US. We got a 10-year, we had a 3-year yesterday that kind of went OK, but a 10-year auction today that I think is much more significant.
There's been a lot of hand-wringing about these auctions, but the markets has just absorbed them.
Yeah, but I think as you go out, if you push out the duration, I think it becomes tougher. And you've got these Ueda comments as well. That sounds like a hint at a rate hike to me And clearly he's getting political pressure to do something about this weak yen, which the politicians are feeling the effect of.
Yeah, he was not sounding bothered about the weak yen at the April press briefing. This is definitely a change of tune from Ueda. Interestingly, I don't know if you've already flagged this earlier in the week, but I'll do it again. The Live Pulse survey this week is about what's still a safe haven asset. What's your favourite safe haven asset? Is the yen still in that category?
Swiss franc potentially still in that on that list.
Gold certainly fits the bill right now, doesn't it?
Absolutely.
But to the
cash
point, so
cash would be the one I would mention.
Cash when you can clip a yield of 5% or something. 155 on the Japanese yen. So to your point, you're seeing softness in the Japanese yen despite Ueda, the governor, coming back. So on the back of these comments from him suggesting, nodding to a potential further hike, the yen actually sold off, down 0.3%. So it, again, reminds us of the challenge of the Japanese authorities.
Soggy auction,
the
lack of that demand. So I just wonder whether that's all part of that as well. Geopolitics is never far from our minds as well. So let's sort of delve into what we need to know this morning about what is happening there. So the latest is that the US has paused a shipment of... These are the largest kind of bombs that are being sent to Israel. These bombs have been basically, the delivery of them has been halted. This as the US administration voices concerns about the Israeli plans for a full-scale assault on Rafah. Israeli forces edging closer into Rafah, edging into Rafah. And this as we watch the talks around a truce, which we got excited about earlier on this week, now looking like they are going to stall. Washington says Israel and Hamas should be able to resolve their differences over this proposed ceasefire. But defining a ceasefire, I think, is the tricky thing here. The word from Hamas appears to be that they are looking for something that is much more elongated, and the Israelis are definitely pushing back from that. Let's talk to Paul Wallace and get a take on what is happening here. Paul, the question that everybody can't really get their arms around at the moment, and the answer to this question is, what is Israel actually doing in Rafah? Is this just a closing off of Rafah? Is this the start of the invasion of Rafah? What is the situation on the ground actually telling us?
Hi, Guy. It is a big question. And to be honest, the answer is a bit of both. It's a bit of Israel beginning what could be a full-on assault of the city of Gaza in the coming weeks. It's also a bit to do with Israel trying to up the pressure on Hamas with regards to the ceasefire talks and try to get it to agree to what Israel wants. As you mentioned there, the main sticking point when it comes to this ceasefire for hostages, these ceasefire for hostages talks, is Hamas wanting any truce to effectively be permanent. Israel says that cannot happen. It insists that the war must continue, even if there's a weeks-long break for a truce, until Hamas is destroyed as a military organization and its remnants in Rafah, and Israel says they're up to 8,000 Hamas fighters there are crushed. So that's the situation there. The IDF's movement yesterday, taking control of the Rafah border crossing, was pretty significant. It's the first time Israel's controlled that side of the Rafah crossing since 2005. Israel is saying that for now it's a limited operation in Rafah. It's downplaying any sort of talk that this is the start of a full-on assault, but that is how it looks to at least some people in the rest of the world. The EU's foreign policy chief yesterday, Josep Borrell, he said this is the start of an offensive. I think it does depend on what happens in the next few days with the ceasefire talks, however.
And Paul, Guy mentioned the AP report about the US pausing a shipment of bombs to Israel. Of course, there's historical precedent for that. You've got Eisenhower, Reagan, Bush Sr. I wonder what we know about where it leaves those ceasefire talks, whether the pressure's actually having any impact on Israel.
I think this is pretty significant. The US has delayed the shipment of about 3,500 bombs to Israel. While in and of itself, that probably isn't going to hurt the IDF much in terms of its operations in Gaza, it is pretty symbolic. I mean, if you'd said a year ago, or even just after October the 7th, that the US is likely to pause weapon supplies to Israel, its main ally in the Middle East, I think you would have been laughed at. And it shows just how strained relations between the Jewish state and Washington have become since October the 7th, and particularly between Benjamin Netanyahu and Joe Biden. I think this is definitely something that Washington is using to put even more pressure on Israel to back away from any plans for a full-on assault on Rafah.
OK, Paul Wallace on the latest out of the Middle East, the US reaching for that lever in terms of the pressure point on Israel. Thank you for the story, of course, the latest, and we continue to watch how this evolves in that region. Let's take a look, meanwhile, at what else is ahead this week. 12 p.m. UK time, US MBA mortgage approvals. Mortgage rates, don't forget, in the US are still around 7%, and yet the real estate market continues to hum along at a pretty healthy rate, it seems. 5:30 p.m. London time, Brazil's monetary policy decision will come through, so a key, of course, EM market there coming through with their decision. It's become increasingly dovish, that central bank under Lula. At 6 p.m. UK time, we are going to get that US 10-year auction, $42 billion US. We're talking about the 3-year yesterday, relatively well absorbed by the markets. Meanwhile, Chinese President Xi Jinping on more friendly terrain. He's in Serbia right now, then moves on to Hungary. We continue to cover that story for you. And later, on the earnings front in the US, Arm with a gauge on the AI demand, Uber, Airbnb and Robinhood. And finally, through the day, we're going to have central bank policymakers from the ECB and the Fed speaking at events. I wonder how vulnerable the markets are to Fed speak and ECB speak, or if it is now all about just watching the data, Guy.
Kashkari was talking about this yesterday. So this is going to be one of the themes that has come out of Milken. This market is hypersensitive to anything that comes out of anybody that has any influence at the Fed at the moment. And it's amazing just the impact that it can have and how quickly it can have. The market seems so on tenterhooks for every speech, for every kind of utterance, that it's really hard to get a handle on actually what the underlying story really is.
And yet, on the forward guidance, it's quite remarkable to look at the difference between the ECB that's been forward guiding June for how many months now versus the Fed that is really, and it's been saying this for a long time, data dependent.
It doesn't know.
But it does. The Fed does not know. The ECB is able to guide all the way out to June and has been for a number of months.
It doesn't know which data it's dependent on, and it doesn't know which time frame of data it's dependent on. This is the theme that comes out when central bankers complain about their communications, that they just have wanted to focus on long-term trends, but the market's clinging on to every twist and turn in that data.
But it's interesting, Tom brings up the ECB. The ECB is guiding to June, and to a certain extent the Bank of England has been pointing us in that direction as well. What comes after that, though, that's where I think there's still a big gap, and nobody really knows. If you just deliver one and then you don't deliver more...
Yeah, the floodgates are open once you start cutting.
Well, maybe you just get some sort of mid-cycle adjustments. I don't know. Maybe you get sort of 2 or 3. Maybe that's what the Fed ultimately ends up doing.
The Austrians, the Germans, the Dutch have been signalling that, look, you could get one cut in June, but that doesn't mean that we come through with sequential cuts.
So I think, June, I think the guidance has been fairly solid, but anything beyond that, I think, is still up in the air, and I think is much more Fed dependent. And one of the things it's going to be dependent on, certainly for the ECB, is what happens in Germany and what is happening with the industrial story. We're going to get more information on what is happening on the ground in the factories. The CFO of Germany's Continental will be joining us. Big auto supplier, of course. It has a pretty good feed on what is happening with the big OEMs. We'll talk more about that a little bit later. Plus, the US-China trade tensions continue to ramp up. Washington now clamping down on fresh chip supply to Huawei. We'll talk about that. What impact is that going to have? And we'll be back to the markets. That Kashkari comment yesterday certainly having an impact, as Tom's been pointing out, not a voter, but certainly maybe just gives us an indication as to what is happening with the idea that maybe the Fed doesn't go as far as many people had originally anticipated. We've already priced that in. But does it go at all this year? I think is a question that I think the market is still grappling with. You got any questions you want to join in our chat this morning? We'd be delighted to hear from you. There's some fantastic functions you can use here. One of them is IB Plus, BBTV Go. Use that. Get in touch. This is Bloomberg. When do the rate cuts come? How fast do they come? That's the big question the market is grappling with. We've already discussed the market being hypersensitive to any comments out of central banks. Rafah Tenconi, founder of ADA Economics, joins us now on set. You've got quite a lot of rate cuts penciled in, and they start in the summer. How confident are you that those rate cuts from the ECB, the Bank of England, and from the Fed are actually going to be delivered?
So, good morning, everyone. It's a joy to be here. For the ECB, I am very confident. I mean, when you look at the data, the industrial recovery is not happening in terms of volume of orders. The labor market, in terms of hiring appetite, is going down. Consumers are coming back, but from abysmal performance. So I really see no reason why they shouldn't cut in June.
So it's June and then July, and then what happens after that?
Well, maybe not necessarily every month all the time, but every other month. But 100 basis points, we see it has a critical mass that can make a meaningful difference to get the recovery going with inflation, which is well anchored at 2%.
The US is not as resilient as it may seem. That's a line from your notes to us, the labour market in particular. And your pricing is still 75 basis points in terms of where the Fed goes, and that is tied to that labour market. That's where the bias is right now. Is that your view? Just unpack that for us.
Yeah, that is absolutely the view. So when you look at the labour market in the US, it has been gradually weakening since last year, but it's very, very gradual. It's just in the last labour market report that you see that when you take the 12-month change in the number of unemployed, which is the earliest leading indicator of the labour market, is now higher than the number of jobs created on a 12-month basis. So when you look at it on a superficial level, of course, the economy is still very robust and the labour market is tight. But when you fast forward into 1 year, I think you will see the unemployment rate rising 1 percentage point. And therefore, you have to ask yourself, why are you keeping rates so high when the Fed itself has made the point several times that it doesn't want real rates to jack up violently. You know, it wants to gently guide the economy.
OK, so the US labour market not perhaps as resilient as it seems. When you think about the market impact, as we inch closer to the possibility of a Trump presidency, how much does the long end of the yield curve depend more on what politics does than what the Fed does?
So what we've been doing at ADA is to try to systematically look at politics, digitalization, the economy together, OK? And we've built fair value models that try to help you guide and disentangle the economic effect from anything else. Right now, we get a strong signal that the 10-year part of the Treasury is way above where the economics would say, even if we have wildly different views on inflation or rates. I mean, you would need to have inflation twice as much or higher to motivate the current yield. So we think that a lot of it is the geopolitics, the politics, and the heavier issuance that you have ahead of us. So my perspective is that certainly in the next few months, the key is the economy. You know, if I am correct and the labor market is slowing down, of course, yields will come down. But when we look with a horizon of, you know, maybe 5 months to 24 months, the geopolitics will definitely dictate the 10-year.
What happens if you don't get rate cuts? What is the economic data going to look like?
So right now we're really in a Goldilocks scenario, right? I mean, we're looking at U.S. GDP at 2.5% this year, 2% next year with the rate cuts. If we don't get the rate cuts, growth probably undershoots, maybe is 1.5.
Yep.
And the question is, who is going to get unemployed first? Well, or second. Because if the bulk of the unemployment is in the lower skilled, which is what we have right now,
yep,
it is a softening of the economy, but it's not a weakening of the housing market, it's not systemic. But if it spreads to higher incomes, which are the ones that have most lever,
yep,
then the risk is that the housing market begins to crack, and then you have a bigger problem, frankly.
Raphael, great to catch up. Nice to see you. Thanks for stopping by. Too short, but thank you very much indeed. Raphael Tejkoni joining us as the founder of ADA Economics. Up next, we're going to be talking about what is happening in the chip space. A further tightening of conditions around Huawei by the US overnight. We'll learn more details about that next. This is Bloomberg.
The Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology. that we don't want to transfer to them, and they don't want to transfer this to the U.S. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
OK, that was Steve Mnuchin, former US Treasury Secretary, speaking to Bloomberg on how the US could rebuild TikTok's technology. This comes with the Chinese parent company, of course. ByteDance made clear that they will not comply with the new US law requiring the sale of the video sharing app, potentially setting up a prolonged court battle. Now, Bloomberg has learned that the US has revoked licenses allowing Huawei to buy semiconductors from Qualcomm and Intel. It is the latest move tightening export restrictions against the Chinese telecoms giant. For the details, let's bring in Bloomberg's James Mager joining us out of Beijing. James, the impacts then on Huawei, they had the licenses, those have been revoked. How is this likely to ripple across the Huawei ecosystem?
It's likely to be pretty limited for Huawei. You know, Qualcomm was only supplying sort of 5G radio chips beforehand, and the company had already said it did very little business with Huawei now because it's been on the restricted list since 2019, and it was expecting that to go to zero very soon anyway. So the removal of these licenses is probably going to make that happen a little bit sooner than they might have otherwise expected. But it's probably not going to slow down or reverse sort of Huawei's proven ability to continue to make phones, continue to make computers without US technology. I think this is really a reaction to what happened last year when Secretary Gina Raimondo was here. She's the Commerce Secretary. She's in charge of these kind of export restrictions. And while she was here in China and I was traveling around with her, Huawei brought out a new 5G phone, which had all of these capabilities and we had the chips in it from SMIC that the Americans didn't think that Huawei could actually build. So there was a real reaction to that from the US, and Gina Raimondo and the Commerce Department were criticized by a lot of people in Congress for not doing more to try and stop that. The question is whether really America has the ability to stop that or not. Clearly, the Chinese companies are putting a lot of money, and the Chinese government is putting a lot of money into to semiconductor technology because they see that the US is trying to stop them from getting it. And what Huawei showed last year was that even with all the restrictions that the US has already put in place and Japan has put in place and the Dutch have put in place, they can still make high-end semiconductors. So these restrictions are probably just the final nail in the coffin for a trade between the US and Huawei, but it's not going to stop. I don't think it's going to stop Huawei from continuing to move forward with their technology.
And James, we've also reported allegations of a cyber attack on the UK Ministry of Defence. Officials pointing the finger at China, though not Grant Shapps, the Defence Secretary, notably. What do you think would be China's motivation here? Is this really a surprise?
I mean, I feel like I'm the guy in Casablanca who's shocked to find that there's gambling going on in a gambling den. I mean, countries spy on each other all the time. China spies on G7 countries, on the Five Eyes countries. They spy on China. This has been going on for decades. China claims it's rolled up well, there's been reporting that China rolled up the CIA spy network in China a dozen or so years ago. The interesting thing, I think, is there's just been a real spate of announcements about Chinese spies being arrested or Chinese hacking being discovered recently in Europe. There was the cases of 4 Germans who've been arrested or charged. There was the case of 2 people, including one researcher for the British in the British House of Parliament. There's been a steady sort of stream of news recently about these kind of things. Whether that's a sign that China is stepping up its activity, or is just getting caught more, or people are deciding to publicize these things more than they had done in the past when they were just quietly hushed up and brushed under the carpet. I don't know. But it does seem that there has been a real, in the last 6 months or so, a massive increase in the number of Chinese spying cases that are actually making it into the media and becoming public.
Yeah. I think nobody's really shocked that this is happening. It's just maybe, as you say, the spotlight being put on it. James, thank you very much indeed. James Mager joining us on the latest stories around tech. There's more we need to fold into this conversation as well. I find it interesting to hear what Mnuchin was talking about in terms of the fact that he doesn't think the Chinese will give them the tech when it comes to TikTok, the algorithm. Tom was pointing that out weeks ago, saying there's no way the Chinese were going to do that. The Apple story I find interesting as well. So Apple out unveiling a whole load of new chips, got all the devices that has come out, new iPad, et cetera, et cetera. But I think the story that really stands out is the fact they're really focusing on these AI chips, and they're talking about server chips as well. Everybody's been waiting for Apple to get its act together in terms of the AI story. It would be fascinating if it ends up kind of being more in the server kind of realm than in maybe in the consumer fronting business.
Well, if they can combine, so they're missing the software and the consumer component in terms of the software when it comes to AI, and that's where investors are screaming out for detail on that. They hope to get that in June. But to your point, where Apple has been prescient, arguably, is building out the infrastructure, and they've been well ahead of many of their competitors in investing around their own in-house chips because they've seen that they're over-reliant on that. If they combine the AI chips with the software component, with all of their devices, then it could be a really, really compelling proposition in terms of what Apple can do on AI. The missing piece right now is still what they're doing in terms of the software element, I think, to layer on top of that hardware.
But they really do need to do something about the iPad. The sales have been absolutely in the doldrums, especially in the last quarter.
Absolutely, but if you think about, is that going to get them an Nvidia-like multiple? Probably not. Would a server chip that is powerful enough to do AI and has the computational power to do that, would that give them that re-rating?
And
maybe
on the edge, which is where you can use that AI on your devices with less energy, more energy efficient. If those chips that AI is building out answer some of those questions, then again, you could end up with these hyper-powerful iPhones and iPads with all that built into it, with all of that additional utility. This is still a big question mark, but if you close that gap, then that becomes really valuable potentially for Apple.
So you spoke to the DeepMind's CEO yesterday.
Yes.
You're not allowed to kind of give us all the kind of the details of what came out of that conversation. No, I'm going to try. We're going to get something out of it here. Give me the why am I going to watch this? Because I have to say, of all the interviews this week, this is one of the ones I really want to watch.
I think if you think about Sam Altman at OpenAI, if you were to sit down and spend 15 minutes with him, Demis Hassabis is in the same league. Absolutely the same league as Sam Altman. He is the Google DeepMind CEO. And in the last few weeks, in fact, all of the AI research, Gemini, their model, all of the AI story, all of that work has been put under Demis Hassabis. He's been empowered in the last few weeks. He is sitting atop everything that Google does now on AI. That's why it's so important to hear what he has to say. It's an exclusive conversation. It'll be airing from 4 p.m. today. We talked about a number of different factors. I can't touch on all of them. But in terms of the money that's been invested in the space, he says actually investors are overestimating the near-term opportunity around AI, overestimating the near-term, underestimating the long-term opportunity. There's a lot we discussed, but in terms of where he sits, he's there on the throne alongside Sam Altman and others. 4 p.m. UK time.
That was what I call a tease, OK? That's how you do a tease. OK, looking forward to that conversation. AI, a theme that's been running through many of our conversations over the last few days. Anna's not here today because yesterday she was in Berlin and she was talking to Bill Gates, who is obviously leading a huge philanthropic efforts in many of the most deprived parts of the world. And he thinks that AI could be actually one of the key tools that ultimately ends up being used to maybe allow some of these people, allow some of these communities to catch up. So he was speaking to Anna at the Global Solutions Summit.
You know, it's estimated that Africa is missing 4 million health workers, and you know, we're not going to have enough finance to come up with that. And so the idea that we should take these AI capabilities and create that, it's very, very exciting.
Bill Gates talking to Anna yesterday at the summit that is taking place in Berlin, addressing the issues of how maybe actually AI, the overlap between AI and what is happening in Africa could be much greater than anticipated, touching areas that maybe we hadn't originally anticipated. Let's turn our attention back to the relationship between China and the West. Over the last few days, the Chinese President Xi Jinping has been in Europe. Today, he arrives in Serbia. This is the second leg of his European tour. He's very much seeking to tighten Beijing's links with the Balkan nation, which has embraced in many cases, significantly more Chinese investment than much of the rest of Europe. He's going to be in Hungary later on as well. He's going to be speaking to Prime Minister Viktor Orban, standing nearly alone, you could argue, amongst EU leaders in maybe talking about closer ties to China. Let's get more from our Budapest bureau chief, Zoltán Simon. He joins us now. How different will what is happening in the rest of Europe be compared with his kind of meetings that he's going to be having in Serbia and in Budapest a little bit later on? Talk to us about this leg and how it is different to the earlier legs of this tour for President Xi.
Well, I think it will be very different. It will be much more welcoming, probably, for the Chinese president. Obviously, he started his first leg of the trip in Paris, where trade tensions with between China and the EU were front and center, whereas here in Serbia and then in Hungary, these governments have gone essentially all in on China, Chinese trade, Chinese investments. There are billions of dollars worth of infrastructure projects going on. There's one actually in the works that will link or modernize a rail link, multi-billion-dollar project that will connect Belgrade, the Serbian capital, with Budapest, the Hungarian capital. So the leaders in Serbia and Hungary are very much looking forward to this visit. And in fact, the Chinese president is also hailing this cooperation between these two, with these countries as a model for what Chinese and broader EU relationship could be.
And Zoltán, of course, the timing's significant as well, because today's visit in Belgrade marks the 25th anniversary of that NATO bombing that also hit the Chinese embassy in the Serbian capital. Doesn't it still reverberate there?
It does. In fact, the Chinese President Xi wrote an op-ed in a Serbian newspaper ahead of his visit, saying China will never forget that event. And indeed, it reverberates in China's foreign policy to this day. Basically, it has sown distrust between China and the West, and China and the U.S. in particular. And this is obviously a crucial moment because China and Russia have declared a no-limits friendship between them, and that obviously poses difficulties because it's helping sort of Russia weather Western sanctions that were imposed in retaliation for its invasion of Ukraine.
OK, Zoltán Simon, Budapest bureau chief here at Bloomberg, across that visit of Xi Jinping to various countries, shoring up the relations between China and the West. But coming up, we'll look at your stocks to watch at the open, including Siemens Energy, after the German manufacturer announced it's cutting jobs and output in its wind turbine business. We'll get the details for you next. This is Bloomberg.
I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on is disinflation in fact continuing or has it in fact stalled out. I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time.
But he's not ruling out a hike. We sit here for an extended period of time. The chairs look comfortable, but he will not rule out a hike. He's very much at the hawkish end. He's not a voter, so take it with a pinch of salt. But nevertheless, Neil Kashkari, they're sounding, I would say, arguably reasonably hawkish at the Milken Institute Global Conference, which is taking place in California. If you believe that hikes are still on the table, has the two-year peaked? That is a question that is ruminating around the mind of executive editor for Markets Live, Mark Cudmore, this morning. Morning, Mark. You are coming to this idea that maybe actually the US two-year has peaked. If it has, what are the implications?
Yes, Guy, absolutely. I think I would have put myself very much in Kashkari camp in terms of that. For this year, I'm a known hawk and I'm not a voting member of the Fed. But what he always said until now made sense. But we always dismissed his views in the same way that my views don't really influence policy either. So they shouldn't have too much reaction in the short term. However, while I would have argued up till now that we shouldn't rule out a hike, I actually think there's a chance the 2-year yields might have peaked. I think that or at least I'm growing in conviction, that view. I said before they might have peaked, but I didn't have much conviction either way. I thought there might be another scare to the top side. I now think 2-year yields probably have peaked. I think there's an increased softness coming through, and I think the study coming through from the San Francisco Fed that excess savings have finally been worn down. This has been the big topic of the last few years. What we really cared about last year, we forgot about it when their estimation of when they'd run out was wrong. The San Francisco Fed got it right. They said it would run out middle of this year. Just last week, they said they finally turned negative. So I think we're starting to see some consumer weakness. That might be an issue for later on this year, not on an immediate basis, and therefore 2-year yields has probably peaked. What does that mean for other assets? I think value stocks can continue outperforming growth stocks, a nascent theme we've seen a little bit of recently. I think China, Hong Kong stocks can continue to do well. They're decorrelated from the US as much as possible over the last couple of years in a globalized world. And I think it does enhance the view the dollar as well has probably peaked, but the topping process will probably be volatile.
Yep. Okay, so what happens to the shape of the curve in this environment?
It steepens from here. I think it's going to steepen in a volatile manner. So if you think that the Fed's dovish reaction function combined with the fact that we might have just passed peak optimism on the economy, I'm not talking about some doom-mongering scenario, just that we're going to start getting a little bit more negative on growth and the dovish reaction function. That will cap the front end of the curve. So 2-year yields will probably continue to come lower, whereas 10-year yields will whip around with sticky inflation versus negative growth. But ultimately, it's probably a steepening bias over the next couple of months.
Great stuff, Mark. Thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cudmore joining us there. You want to figure out what Mark's thinking, what the rest of the team are thinking. There's a place you can do that. MLIV Go is the function on your Bloomberg, Lizzie.
Now, gentlemen, is it too early for beer?
Now, yes, but yesterday was warm, so we're warming up to the idea.
It's true. It's been good weather here in London. Let's talk about the beer maker AB InBev. It's to adjust and increase its pre-tax earnings by mid-single digits this year after better than expected first quarter results in the US market. We had the results at 6 a.m. London time, and we can break them down with Bloomberg Intelligence's Duncan Fox now. Duncan, we've had Henkel's consumer brands business operating margin still way below peers. I wonder how long it's going to take to correct that and what we can read into the AB InBev results about the strength of the European consumer.
Well, it's interesting that people are still buying premium beers. That's a good thing, because that's the whole strategy for AB InBev. But obviously there's also people buying bottom-end beers as well. It's the middle that's getting squeezed badly. So you mentioned Henkel there. That's the problem for Henkel at the moment. They've got quite a few middle-ranking brands, because P&G or Unilever or maybe even L'Oreal will be the peers they're up against in their consumer brands, which is half the business. So it's going to take Henkel quite some time, I think, to get back to peer margins. They basically didn't invest enough in the sort of late 2010s in the brands, and so they're restructuring it. And it's going to take them time. But AB InBev, they've had a pretty awful year, as you said, in the US. They're probably through that now, so you should see stabilisation in their key market for profits. But elsewhere around the world, people are buying premium brands, and that's good for their margins. It's going to take some time for them to get back to peak, though, because they had ridiculously high margins, and they're up against some pretty strong competition in Heineken and Carlsberg globally.
Duncan, the marketing cost is important, isn't it? I mean, they had the major marketing misstep, and that's been generous to them in the US. You're pretty clear they're over that, and the sales dropped 9%, less than the estimates in the US market. When we think about the cost of marketing, particularly in an Olympic year, something that Lizzie's obsessed with, how does that factor into the fortunes of AB and InBev and their brands going forward?
Well, it's a big year because they're also the European Football Championships as well. So they're going to be one of the key sponsors, along with Coca-Cola, and they will undoubtedly have that in their budgets already. So their target of 4 to 8% EBITDA growth has that plugged in. But the fact they did 5 and a bit % in Q1, where you've got the horrible US numbers and you've got, actually you had Argentinian currency give them a smack as well. And Asia wasn't brilliant because the economy's just been a bit dull. I think, they're pretty well set, providing, excuse me, you don't get a summer like last year, which was hideous. The weather was just wrong in many ways for beer manufacturers, simple as that. If you get a normal summer, you could see upgrades coming through here because
that's what we should use on our weather forecast. The weather is just wrong. Thank you very much for that.
To be honest.
I'm not that good. I can't give you that.
Thanks, Tony. We'll come back to you with the weather check in the next hour or so. On the deep dive around AB InBev and a change in fortunes, arguably, for that brewer. Thank you very much. From Bloomberg Intelligence, Duncan Fox, of course. Let's cross over to Joe Easton now. Bring Joe into the mix with the stocks to watch this Wednesday. Joe, what are you looking at?
Morning, Tom. So we're starting with autos because we've got a couple of big reports out of Germany today and neither of them looking great. Both BMW and Continental looking pretty weak today. Automotive margins over at BMW missing expectations. Sales also declining. The only saving grace is the EV sales, electric vehicles, up around 28% for the last quarter. Then in terms of Continental, it is weak as well. They do say that 1Q, however, will be the weakest of the year, so potentially a bit of a trough in the earnings. There's a net loss versus a profit last year and the EBIT below expectations, though Continental has already warned on earnings, so potentially a bit of that priced in. Then we're looking at Siemens Energy. Finally, a bit of positive news. They're upgrading their outlook today for sales. They are seeing strength in the gas and power division. Margins also a little bit better. Gamesa remains weak, but it is the orders in the core business that are going to boost this stock this morning, and we spoke to the CEO about that earlier today.
So we see, let's say, a good momentum also going forward. What we have to decide is what is the right speed in growing. We're going to remain selective. We're going to obviously want to drive it also with an improvement in the profitability. This is what we're looking at.
That was the Siemens Energy CEO speaking there, but we've also got some breaking news out of Alstom. The worst case scenario for investors, it's a massive fundraising, €1 billion. They're asking investors for most of that done through a rights issue. They've had a bunch of delayed contracts at the train maker, including here in the UK. Their electric train contracts were delayed. They've also had some contracts sour related to their takeover of Bombardier over in Canada recently. That is set for a rough morning, already down 35%. Keep an eye on that one in France.
Great stuff, Joe. Thanks very much indeed, Joe, updating us on a lot of industrials out with numbers this morning. Up next, we're going to talk you through the impact that the numbers that we're seeing this morning are going to have on those stocks. The market open is next. Futures, though, broadly positive. We'll deal with the details next. This is Bloomberg. 2 minutes ago until the start of trading this Wednesday, the 8th of May. This time yesterday, we were talking about UBS. UBS gapping sharply to the upside. Infineon doing the same thing. Two big drivers of the equity session yesterday. Today feels a little bit more muted. We don't seem to have those same catalysts maybe in the market driving stocks higher. Yesterday was a solid session. Today feels a little bit more muted, Tom.
It does. I mean, futures are flat, frankly. And we've had some interesting earnings stories. So you lift the hood, and there are some interesting evolutions, whether that is within the autos market. We'll be digging into that in more detail with Continental. But on the AB InBev story that we were just touching on prior to the break as well, and what seems like, at least at the top end of their brands, that relative resilience coming back through for a company that has that touch point on the consumer. Interesting, we have some reporting out of the US today about the exposure to some of these buy now, pay later products in the US, and what that could tell us about maybe the debt load for the US consumer as well, at a time where, of course, we still wrestle with the question about rates. And Neil Kashkari giving himself plenty of optionality. It's
interesting, the consumer, in some ways, has run out of savings. Is the consumer now gearing up to drive the strong data? I think we're going to get retail sales in a few days' time, maybe confirming or kind of pouring cold water on that idea. So Tom is in the kind of premium beer market this morning. Lizzie's in the premium sneaker market, trainer market.
I am indeed. We've had the Puma results this morning, and I think things are going to look up for Puma later in the year because, of course, you've got big sporting events on the calendar. The Olympics in Paris and the UEFA Euros.
Favourite event in the Olympics?
Swimming.
It's okay, you don't need trainers for that.
Not now, at least.
No.
Flippers, I don't know if Puma makes them. But look, this is an opportunity to make more technical sneakers, which is where the margin lies.
That's interesting because it's interesting that the fashion story's been maybe made the driver recently. Anyway, right, markets are about to open. As I say, a muted morning, I think, is probably what we are anticipating. In terms of the early gainers, in terms of the points that we're seeing added, Novo is up, so that's going to add some weight to the upside. HSBC is also adding points to the upside, but Anheuser, here we go. up quite nicely as well. It is rising, rising quite sharply, actually, up over 4% already at the get-go of trading here this morning.
That's a very solid, punchy gain coming through from AB InBev on the beat that's come through. Of course, all those concerns about the massive misstep on the marketing campaign around Bud Light in the US, that being put to one side, they seem to have addressed that. That was the takeaway from Bloomberg Intelligence. And the outlook as well in terms of the premium segment, AB InBev now up 4%.
But Siemens Energy down 0.2%, so their headaches over the wind turbine business not in the rear-view mirror, like AB InBev's managed to put the marketing headache in the rear view.
They had an earnings beat on the top line for Siemens Energy, but they are wrestling, of course, with the Gamesa unit, and they're starting to rationalise that business. We also talked, when we spoke to the CFO, about competition from China, and he accepts that there is going to be very, very significant competition from those cheaper units coming through in terms of the wind turbines from China. This at a time, of course, when we focus on that visit by Xi Jinping. But across your markets, top of the list then, AB InBev with the gains of around 4%. TUI also posting some gains of around 5.3%. Yep. On a sector-by-sector basis then, Guy, and we'll be talking about energy with Freddie late in a moment because he's exposed to the energy sector. Basic resources down 0.6%. Top of the list, though, is personal care and products up 0.7. Food and beverage now punching at the top in terms of the leading sector, up 0.8%, with AB InBev, of course, within that.
Yeah, that's the big driver of that story. Interesting that I find it fascinating that the premium market is still doing as well as it is. In some ways, you'd expect maybe the consumer to start backing off, and you would have expected maybe this, and I thought we'd seen some evidence of this premiumisation rollover that was happening, but it isn't, according to AB InBev. But other brewers are talking about kind of some risks in that market.
This kind of takes back to the theme that you keep pushing in, which is the mixed macro picture in terms of the data and the uncertainty there. And I wonder if we're getting a similar mix when it comes to the corporate story on the health of the consumer. Starbucks obviously taking a hit as people are buying less Starbucks coffees priced at $4. And yet those same consumers are presumably buying the Hoegaarden at $5 or $6, but not buying the cheaper stuff. So
maybe it's just expectations. Maybe just the expectations were a little bit lower in terms of what these numbers were going to deliver. Anna Edwards had a massive issue the other day. Was it lavender lattes? I think.
Oh, that tastes. The thought of that's revolting.
That was her reaction as well. That was her. I said it in a gin and tonic maybe, but not in some kind of a latte. But the reviews are actually quite good. Anyway, I digress. I don't know why, but we do. I think the real story that stands out to me this morning, though, is that we come back to what is happening with the industrial story out of Germany. The industrial data at the top of the last hour was maybe a little bit better than anticipated, but all of these German big, heavy industry manufacturers are talking about a recovery in the second half, and I'm wondering if that is premised on this idea. It is presumably premised on this idea that we are going to be seeing maybe the central bank coming through with some sort of a rate cut later this year. This time yesterday, we were talking to Beata Manthi over at Citi. This was her take on what is happening with these markets.
What we are noticing in this reporting season is the market is really focused on the delivery. So the companies get awarded much more in the previous quarters for the beats, and they get punished much more than in the previous quarters for the misses. On a relative basis, our view is that you buy continental Europe versus the US, and cut will help.
Beata Manthi, Citi's head of European equity strategy, speaking to the team yesterday morning. I want to point out that Siemens Energy opened now, and that stock up significantly, up by over 8%. So some signs of life maybe in the German industrial story. Let's carry on the conversation and talk more about what is happening. We're joined now by Freddie Late, managing partner at Latitude Investment Management. Equity holdings there include AutoZone, McKesson, Visa, Alphabet and Tesco. Freddie, good morning.
Good morning.
Nice to see you.
You too.
Do you have a handle on this market right now? It seems that we are being whipped around on a daily basis. We're seeing huge moves for big stocks, like Siemens Energy up by over 8%, but even some of the big tech stocks are being whipped around by 7, 8, 9, 10% as their earnings come through. You've got some of these in your portfolio. What does that tell you about investor understanding of what is really going on?
It tells you it's low.
Yep.
And there's quite a lot of uncertainty. And I heard you guys talking a minute ago about this sort of mixed macro message, you know, consumer excess savings dwindled now, spending getting cut in certain areas, but still going gangbusters in others. I think we're at a point of intersection in the market where we see if we do finally follow through on a soft landing in the US, everywhere else is pretty mediocre, or if actually we see that consumer slowdown and we have, as we always suspected, borrowed from the future with all the spending and stimulus. So I think it's a real telling 6 months. Next couple of quarters are going to be very interesting. Some of the big moves, though, can be explained by other factors. You know, in Europe particularly, there's a lot of lagging, very good businesses. There's a lot of awful ones too. So I wouldn't buy Europe as a thing. But, you know, when you're seeing these stocks delivering results like Infineon, matching some of the numbers that are coming out of Texas or Analog, you will see that recovery trade coming through as people are finally broadening their horizons a little bit outside of the Mag 7 into the wider market. So I think there is a bit of market breadth, which is healthy. There's still a strong consumer and a reasonably strong economy, which is healthy. But, you know, interest rates are high, and that spooks people in high-growth, quality, sort of expensive stocks, as it should. And I think we're in for a tumultuous or turbulent summer.
So what do I do there? I don't know. I see potentially kind of a tumultuous summer coming up. Do I batten down the hatches and sit in cash? I know what I'm going to get there. How do I navigate this period? If I don't, it could go all one way, it could go all the other. What do I do?
So some people will go into cash. I mean, if you can get more than 5% in cash, that's not a bad outcome. You know, I'm an equity stock picker, so I'm not going to do that. But I think, you know, some people certainly will. Within the equity market, I truly believe you can find companies, you just named a few of the ones we own, which are growing very nicely, trading inexpensively. Something like McKesson reported last night, it's growing 15, 17% a year. It's on 15, 16 times earnings. That is a traditionally high-quality business. It's one of two massive players in drug distribution in the States. Finding businesses like that, or AutoZone, which you also mentioned, you know, it's on 17, 18 times earnings. It's grown at 20% a year for the last 15 years, continues to deliver those sorts of growth rates. It is in line with the growth delivered by the Mag 7 or other companies, not NVIDIA right now, but, you know, as a group. They are defensive, and you can find these businesses if you look. Some are in Europe, you have to dig around a bit, but I think that's where you need to be sharpening your pencils rather than chasing the momentum.
So part of the discussion we were coming back to at the start of the show around whether or not the second half is just more insecurity and more uncertainty for these corporates and investors, or whether you get this combination of catalysts, whether that is China, lower rates and a relatively healthy jobs environment in Europe. I know you've talked about a challenge. You need to strap yourself in for the next 6 months. How do you think about that? You think it plays out in terms of more uncertainty? You're not convinced that those additional catalysts come to play in a meaningful way?
Yeah, it's not. I'm not predicting a crash or anything like that, and I'm sure plenty of people have, but no one's got a clue. I'm just saying I think it's really uncertain. And so, yeah, so those catalysts may be there. And, you know, 8 months ago we thought the Fed might, or the market thought the Fed might cut, you know, 200 basis points. Now they think they might not at all. I don't really see interest rates as the biggest driver for the stocks we own because they're trading on average 14 times earnings. It doesn't make a huge difference. But you know, that is going to be the driver of the main generals of the market, the Mag 7 and things like that. So, yes, you kind of require a sense of dovishness there. The underlying employment numbers are amazing, as you say. So you've got, you know, my point is more that you've got pros and cons widely stacked on the scales, and I don't think you know which way it's going to tip. Not that I'm trying to predict it's going to the con side.
But back to the sector story. You like energy, for example. It's cash generative. We're seeing that again, even with BP, slightly challenged, but coming back with the buyback. When you compare that story to the Mag 7 story, there's an argument you can make that some of those mega-cap tech stories, with their own buybacks and return of cash to shareholders, are also becoming value stocks. Am I overstretching that, or are you starting to rethink some of those big tech names in the context where you quite like those cash-generative companies?
So it's exactly right. I mean, you need to look at these businesses on free cash flow. And, you know, with BP or Shell or stocks like that, you're getting a 12% cash return at $80 oil. So that's the buyback and dividend added together is 12%. Any growth's on top, and if it moves from 5 times earnings, that's on top as well. With a more expensive company, the buyback just has less bite. So if the stock is trading on 25 times earnings and cash conversion's 100, the most it could buy back is 4% of its stock, whereas these guys are buying back 6 or 7. So that's the first difference. The second is the massive capex rollout that's going on within the big tech companies. So actually, if you look at their gap earnings and then you look at their free cash flow, right now there's a smaller level of free cash flow because they're investing so much in AI and data centers. So that's not to say that stocks like Netflix, which have pivoted from basically not generating cash to generating tons of it, Meta attempting to do the same with some of its cost cutting, that is exactly the right way to look at it. And we like these businesses. I think the point being, I think one should own some exposure to some of these businesses. We have some. But alongside that, be a little bit more inventive and have maybe some energy companies, maybe some banks, maybe some defensive value stocks, if you want to call them that. You will end up with a blended diversification of growth that will see you through the various outcomes as I predict them. It's cheaper, so you're not as exposed to interest rates, and I don't know, it's a bit more exciting.
And as someone who holds BP, of course, we heard from them yesterday. What did you make of Auchincloss saying, it's time to invest in low-carbon energy, do some M&A, go counter-cyclical?
Yeah, I mean, they haven't proven to be very good at low-carbon energy yet. But it's probably going to be in the wheelhouse of the big, the big IECs around the world. So I do think with this excess free cash flow, spending some, not none, like the Americans, is a good idea. They have done a lot of write-downs in the last 5 or 6 quarters. I mean, so there was another, I think, 700 million write-down yesterday. Just went unnoticed. It's an enormous amount of money. And these are all write-downs from the renewable investments they've made in the last 2 or 3 years. And so they've already proven themselves to be quite bad at that. I think they'll be quite good at operating them. They have the engineering expertise and the massive global scale. They can integrate these projects into their trading business, which is fantastic, but also their distribution business. So I like it from an operating perspective. But the M&A so his point is they're now cheaper. That's hence all the write-downs. So now we should be doing it. Well, it's like you sort of shouldn't have been doing it last time, so how can I believe you this time? But I do think some portion of their capex needs to go into that, not just from an environmental perspective, but from a corporate perspective too. It's rational. So if he finds some good deals, genuinely good deals at less than asset value, then I'd support it. But
now I understand the long pause. If I can take my shot on the macro story, you've written about how a soft landing may yet beget further inflation. We've been playing Neil Kashkari throughout the morning. Are you in the camp with him that sees a chance the Fed hikes before it cuts?
Yeah, I can see a chance of that.
How big a chance?
I think it is data dependent. I mean, it sort of depends. But inflation is bottoming and plausibly ticking back up in the US. If inflation goes to 5.5, I give you a high chance. And I can see it happening. I mean, I'm not saying it's going to. Again, I think this is the story of the moment, is like very wide tails of likelihood rather than a real central case. But yeah, if inflation carries on ticking up, we've seen goods deflation stalling now. I believe energy prices are going to go up, and that's a major component of inflation and inflation expectations. Services seem to continue to be pushing through major price increases. I don't know what's going to happen with housing, but, these are the main pieces. If that starts ticking up and it's 4 going to 5, it's not a cut, and it's certainly hawkish language, and I don't see why they wouldn't cut. I wouldn't raise.
Can I come back to BP for a moment? Because I think it's sort of emblematic of a number of different stories that are going around at the moment, one of which is... And you touched on the kind of the new energy story as maybe one reason for this, but European energy majors trade on a discount to their US peers. Why do you want to own European energy majors versus US energy majors? Why isn't Exxon in the list rather than BP in the list?
Very similar company. But it is because of that discount that we want to own the European ones. But
you want it... do you think that discount closes?
No, not necessarily. When we buy stocks, we tend to own them for nearly 10 years. That's the sort of average holding period. So we're thinking over that period of time. If you're trading at, I don't know if Exxon's on 9 times earnings and BP's on 5, something along those lines. BP's cash flow yield, they're both generating a similar level of cash flow at an operating level, can buy back twice as much stock and return twice as high a dividend to us. And so where you may be getting a distribution yield, I don't know the numbers of it, in Exxon of something more like 6, and then your growth and maybe re-rating on top.
This is just an income story for you.
You get buyback and dividends, you get 11 or 12% at current oil prices. That's already a market-beating return with no growth and no re-rating. It is a very nice component to a portfolio. I do believe at some point in the future there is a high probability that discount narrows, but it's not going to be the next couple of years because European investors are basically banned through all the recent regulation from buying these stocks.
But you can.
But we can.
Freddie, great to see you. Thank you very much indeed. Freddie Lates, Managing Partner at Latitude Investment Management. Thank you very much indeed. There's a few stocks that I want to mention. Let's start off with the core 6 here in Europe. Ferrari. I just want to kind of draw your attention to Ferrari. Yesterday out with, by Ferrari standards, very muted numbers, and the market reacted quite strongly to that. It's interesting to see that stock under a little bit of pressure this morning. ASML strong yesterday, so we're kind of backing off that a little bit. Novo continues to climb a little bit higher. The story that, Tom, you were just pointing that out during the conversation we were just having with Freddie on our little chat. Siemens Energy just restarted trading. It's up by over 11% now.
Yeah, it's pretty remarkable. So they had a temporary pause in terms of trading because of the volatility, it seems. Double-digit gains coming through from Siemens Energy. Look, this is something you've been flagging as well consistently, is just the scale of the moves that we're seeing on some of these stories now. It was an earnings beat. They're working through some of their issues with turbines, and they're rationalising the business, and they're being rewarded for that.
Let's catch up with more of this story and what is happening with the wider sector as well. Joe Easton's got the details of that. Joe, over to you.
So Siemens Energy, as you say, getting that massive jump at the open, up around 11% following those earlier trading halts. Now, it is the core power and renewables business that is doing well at the company. The wind turbine business, Gamasa, cutting jobs. The CEO of that business is stepping down, but the market focusing on the rest of the business, and we're up 11% for that one this morning. But I wanted to bring up SMA Solar, which is a peer over in Germany, getting absolutely slammed. It is a profit warning, cutting their sales guidance related to the construction and home industry, people not installing as many solar panels in new homes, people and builders. That stock down 14%, kind of shows us it's not a sector move on Siemens, it is individual. And Alstom, over in the train space, getting a 10% jump in France. It did drop 4% at the open of trading. They're asking investors for around €1 billion. Part of that is through a rights issue, but that stock had 3 consecutive years of decline, so finally a bit of a rebound for Alstom on those debt worries this morning. Then in terms of some other earnings, we're going to look at those car makers, Continental, the parts firm, falling, and BMW as well. Margins at both of those were pretty weak. They are seeing rising wages, rising energy costs, supply chain issues, still a constraint for both. Continental is the underperformer, so BMW kind of catching up with the declines on that one, both of those dropping. In the beer space, you were discussing that with BI earlier. AB InBev getting a decent gain, the maker of Bud Light, also Stella Artois, all of those favourite brands. Everyone looking forward to the football and lots of beer drinking there. They are seeing strong guidance for that one. One firm that is at the lower end of guidance, my old favourite, JD Wetherspoons, that one coming up. They have got some sales guidance. They don't show the football, unfortunately, for them, so they won't get that Euros boost. But they are reporting pretty strong sales out of Spoons this morning. Then we'll take a look at a couple of others that we had our eye on in the pre-market. Puma, there it is. Lizzie Burden reckons you can get Puma slippers. I haven't seen those myself, but that one is gaining. They are trying to compete with the Samba shoes out of Adidas, doing pretty well. But Boohoo, the online clothing retailer, warning of some weakness in the consumer market. That one's got some debt issues as well, so it's coming down. And a couple of other consumer ones, Hold, the big grocer over in Amsterdam, and Henkel, the maker of chemicals supplies into the pharmaceutical space. Both of those getting decent gains following earnings as well. I wanted to check in on the airlines this morning because yesterday Ryanair's CEO shocked the market by giving an interview saying that prices will be lower over the summer. Good news for all of us, but not good news for the sector. All of those stocks absolutely slammed yesterday. We're seeing a bit of a bounce back in EasyJet and Wizz. Ryanair, though, hit by those issues over at Stansted. Anyone who's managed to get out of that airport this morning, they've done very well because they have had issues with their turnstiles. That one is underperforming. Lufthansa does actually have an upgrade over at Barclays this morning. They reckon you should buy the dip on that one. Finally, quick shout out for Borussia Dortmund. What a win for them. They did beat Paris Saint-Germain. They've reached their first Champions League final for 13 years, and the stock is up 8% this morning. It's a massive gain for them. They'll get €15 million in prize money immediately from that. Will they upgrade their guidance? Doing very well. We've got the other game tonight, Bayern Munich, Real Madrid. Who will they face at the end of the month? But for the moment, Borussia Dortmund up 8% following that victory.
Joe Easton from our equity team, thank you very much indeed. Arsenal still top of the Premier League is the most important line when it comes to football. Thank you, Joe. Checking in on the breaking news around an AI chip maker, Graphcore. It's long struggled, in fact. It was once valued about $2.8 billion. Now it seems SoftBank is in more detailed talks. Apparently these talks have been going on for a couple of weeks at least, and if not a couple of months. SoftBank in talks then to buy the UK AI chip company Graphcore. Really interesting as well, of course, given SoftBank has majority ownership of ARM, based in Cambridge. This company, Graphcore, based in Bristol. So see if there will be some interlinkages there if indeed this deal comes to pass. But we know this company, which is backed by the likes of Sequoia and Samsung, has struggled in terms of the financing. It once touted itself as a competitor to NVIDIA. So this is pretty intriguing on a number of fronts. Once again, another UK asset being eyed by either US, but this time Japan, in terms of potential value. And we'll see how it ties into SoftBank's portfolio, if indeed, of course, it comes through. There have been big question marks around Graphcore for a long time.
If they had a better owner? Is that...
Well, the financing issue becomes...
Right.
Mute, doesn't it, essentially, because you have the deep pockets of SoftBank, and then if you get a combination, if you're able to integrate Graphcore, maybe that's the plan, you integrate Graphcore into ARM, they do very different things.
That's what I was wondering, yeah.
But maybe there's the add-on there, so there's the synchronies potentially how they synchronise those two, the cost savings, the efficiencies, but of course the financial backing, most importantly. This is a very R&D intensive, capital intensive industry, Graphcore trying to break into the chip space around AI. If they had the backing of SoftBank's deep pockets, that could really change the fortunes, of course, of that company and become a real prospect. But again, it raises a question mark around the UK's own ability to build out its own infrastructure, indigenous.
Yep.
We're currently failing to do that in a real and meaningful way.
Which is interesting because London is seen as, Cambridge, etc., seen as a real, kind of one of the few nodes in the world where AI is really kind of being seen as being very strong. And that takes us to your DeepMind conversation.
Yeah, and this is another homegrown story, of course, but once again bought out by the US, because it was DeepMind, of course, that was set up here. And I'm going to be speaking, and have been speaking, to the Google DeepMind CEO, Demis Hassabis. He is a pioneer in the world of AI, sits alongside Sam Altman in terms of his influence in the space. That conversation will start to play, that exclusive interview, 4 p.m. UK time. Coming up, high manufacturing costs hit a luxury car maker BMW in the first quarter. Back to that German industrial story. Then we take a look at the earnings in the auto sector. That is next. This is Bloomberg.
Let's get back to the earnings story. BMW shares slumping this morning, down 4.2% after earnings declined in the first quarter. Rising manufacturing costs weighing on the luxury car maker's profitability. Let's break it down with Bloomberg's Craig Trudell. Craig, it seems that this is more about the manufacturing costs than the health of the European consumer that we've been discussing throughout the morning.
Yeah, I think sales have actually been sort of pretty resilient in Europe and for BMW in particular. I think in addition to the manufacturing costs that you flagged, the weakness in China is notable. I think a 4.1% decline in the quarter for BMW in China for the main brand. I think that's something that we're seeing really sort of universally at this point, where if you're an international car company in China, you're not seeing the growth that you became accustomed to over decades. It's really tough sledding there.
What's the story on Toyota? World's biggest car maker. They've had some challenges, a scandal, output has been reduced. What are the top lines coming through from that company?
Yeah, I think in terms of the outlook, this is a company that is very consistently extremely conservative in the numbers that they set. So it's a company that, is only, and I say sort of tongue-in-cheek, only going to make 4.3 trillion yen this year in profit. And I think we can sort of, pretty reliably count on them to exceed that just based on past precedent. A record 5.4 trillion in operating profit this past fiscal year. I think they're going to be fine. I think one of the things that stood out for me in their outlook is electrified vehicle sales were 37.4% of their total for this past fiscal year. They're seeing 46.4% this fiscal year. Obviously, electrified includes hybrid. But, they're coming up on half and half, actually, hybrid and EVs.
Which they were critiqued for, and now they're benefiting for.
Hugely benefiting from hybrids making a comeback.
10 seconds, no beating a race from Ferrari. Why not?
I think it's a case of tough sledding again in China, where you're seeing actually a 20% deliveries drop in the first quarter. They and Porsche both flagging that as a weakness.
Nice new cars from Ferrari, though. We'll see what happens with those. Craig, yeah, they do look good. OK, coming up, we're going to talk to the CFO of Continental. That's next. This is Bloomberg.
This is Markets Day, 30 minutes into the European trading day, and we have a decision coming through from Sweden's Riksbank, the central bank then, cutting its policy rate to 3.75%, in line with the estimates then, and it seems the importance of addressing the economic decline in that country is outweighing concerns about weakness in the currency. 4 straight quarters of shrinking growth for Sweden. They are cutting rates. The first time this century they've gone ahead of the ECB and the Fed in terms of moving rates lower. 3.75% is a 25 basis point move from the Riksbank guide.
So the currency has been recovering recently. There's been this kind of expectation that we were maybe seeing that continuing because the Riksbank was likely to go maybe more in line with the ECB. The fact that it's front-running the ECB represents to a certain extent quite a significant risk. How far in advance are they prepared to go? If let's say you get a June cut, and then you don't get much beyond it. Kind of how does the Riksbank manage that? At the moment, you can see the currency is certainly weakening on the back of this euro Swedish krona. As you can see, the beginning of a move there, certainly seeing a weaker Swedish krona. And as I say, it has been starting to maybe gather a little bit of steam recently. And this, Lizzie, goes to the question, the Bank of England's got to face a similar question. How far in advance could it be prepared to, for instance, front-run the Fed? Yeah, and you've seen the bearish bets on the pound. Look, the bigger picture about the krona is it's the worst among its G10 peers against the euro. It's been down, I think, about 1.5% against the euro since the March meeting. And if you've got... if you look at the data, services firms' pricing plans still point to ongoing pressure. So the data, as everywhere else, doesn't all point in the same direction. What it does for inflation as well would have been debated, no doubt. And again, 2/3 of economists had expected this move lower. It was not consensus. It was a relatively or a very live meeting. They've gone with a move lower. There's going to be concern maybe about that pressure coming through. Guy was pointing out it's stabilised a little bit, the krona. Down 0.3% versus the euro right now. What does it do to the inflation dynamics for Sweden, which, again, is facing that constriction across its economy? And getting back to your point, to what extent is this a canary in the coal mine, then, for central banks the Fed in terms of their confidence to go early? They feel they've got to do it. They feel the economic data is of sufficient magnitude on the downside that they feel that they have to make this move. It's interesting, you're already starting to see a pickup in the housing market, but it implies that Europe has confidence that its data is sufficiently dismal, I'm going to use that word, to justify some kind of a move here. Sweden has been at the forefront of the rate hiking cycle in Europe. It probably did so more aggressively than others. It had a bigger inflation problem that it needed to manage. On the downside, does that become symmetrical? The Riksbank says policy rate expected to be cut 2 more times in the second half of the year. So this is not a one and done. And again, the fact that they're committing themselves to that when the ECB is only maybe committing itself to June, I find fascinating. Yeah, that's really interesting forward guidance. It'll be interesting to see whether the Bank of England matches that sort of clarity in the decision. She laughs politely. The unreliable boyfriend, I wonder whether he'll give us that sort of clarity. And I wonder whether they can give that kind of clarity at the moment. The data story in Sweden, in the Eurozone, may be easier to understand than maybe it is out of the UK, and certainly more than it is certainly easier to understand than it is out of the United States. I find they are committing. This is quite a significant commitment. Policy rate expected to be cut 2 more times in the second half. So that's 75 basis points of cuts coming through. In total, it gets you to 3.25% then by the end of the second half, and that clear guidance coming through from the Riksbank. In a world where other central banks are struggling to get clarity. Are they seeing certainty and clarity on the data front that we're not seeing from the central bank? Because to your point, is there now divergence in terms of the data flow coming through for Europe versus what we're seeing in the US? We heard from Andrew Bailey at the IMF saying, I'm pretty convinced, essentially paraphrasing, that the inflation dynamics in Europe have diverged, are in a very different space to those in the US. Are we getting a clearer differentiation? I think you probably are. I also think you're getting a clearer differentiation within Europe. We spent a lot of this morning talking about the weakness in Germany. Sweden is an industrial economy in the same way you could argue that Germany is, and has faced, therefore, some of the similar difficulties that we've been struggling with in Germany. And that takes us to our next guest. Let's talk about what is happening in the German industrial heartland, what's happening in the auto space. We're going to do that in a minute. Miscommunication. We're going to talk to the CFO of Continental in just a few minutes' time. I thought she was ready. She's not, but we'll get her ready, and then we'll come back to it. We'll do that in just a moment. This is Bloomberg. Welcome back. Now, Continental is sticking with its financial targets for this year. That's despite, of course, a rough first quarter for the German auto supplier, marred by stagnant demand and stubbornly high operating costs. A story for the broader sector as well. Very pleased to say we're now joined by Continental's CFO, Katia Garcia-Villa, on the details around the earnings story. Katia, thanks for joining us. An analyst from Jefferies saying there is a lot of work to do in the remaining 3 quarters to reach those targets. How do you plan to meet the targets that you've reiterated today for the full year?
Yeah, thank you very much, Tom. Thank you very much for having me here today. I think we are pretty much sticking to the plan that we've laid out during our Capital Markets Day. So during the course of the next few quarters, the measures that we have already decided on will be kicking in. They will be accompanied by results from the price renegotiations that we are doing with our customers at the moment. And we also expect during the course of the year to grow above the normal market growth, which will also help us and give us some more support for the rest of the year. This is why we are still and we are confirming our outlook for this year, and we expect earnings to improve as the year progresses now.
On the growth outlook, which parts of the business, or at least which regions, are looking stronger, and where is the weakness coming through? Which regions are looking most challenged?
Well, in the first quarter, we were for sure pretty much challenged by the weakness, general weakness in the European market. That was one of the reasons. Another reason was an unfavorable product mix coming from ramp-ups and ramp-downs in the North American market and in the Chinese market. We have not the same content with those that have grown over proportionally in the first quarter this year. But nevertheless, we do see also progress in that area. Now, we had strong order intakes with Chinese OEMs. We've just published a press release saying that we will supply a new ultra-high performance compute, so a central nervous system for the car to a Chinese automotive supplier. So all that will help us now to reach the targets that we've laid out for this year also on the sales side. And that will help us now to grow continuously and deliver on our promises.
Katja, good morning. It's Lizzie. You've talked about the price negotiations. Are you facing more pressure from customers in Europe or in China to negotiate prices?
I think this is nothing that you can answer in a general way. So every customer has its own dynamics. We also have different situations with the one or the other customer. What I can tell you is that we are in partnership negotiations with all our customers at the moment. We've had quite success during the course of the last years when it came to price negotiations, and also when you look at the record order intake that we were able to place with the technologies that we bring to the table, despite the fact that we had to renegotiate prices. I think this is also a very strong sign that the customers trust us, trust the technologies that we bring to the table, and consider us to be a really relevant and strategic player for them when it comes to future safe, comfortable, automated mobility.
And when it comes to cost cutting, let's talk about your labour costs. Have German employees become too expensive for German companies to stay competitive?
We are a global company, Lizzie, so we are not only operating in Germany, we are operating worldwide. We do have the largest employee population in Germany, but we also do have some other very strong countries that we are facing. Labor cost inflation is something that we're not only facing in Germany, but that we are facing worldwide. And all the measures that we have taken now to improve our performance and also to improve our operational excellence are not only targeting to the German market, but they are targeting to improve us worldwide and to bring us into a more competitive position.
Katja, good morning. It's Guy. Does it feel like we are heading, though, for a differentiated global markets? You're going to have the China manufacturers operating in China and maybe some other markets, and Western manufacturers operating in their own markets. Are we seeing a divide in the global car market in a way that we haven't maybe for decades?
Looking at the whole dynamic that is currently in the market, I would not confirm that at the moment. We do see that there's also the drive of Chinese suppliers that are thinking about building new production facilities also in other areas of the world. And we, as a strong supplier in the Chinese market, will be happy to also serve those customers worldwide. While on the other side, we do have really strong European or American players also in the Chinese market with certain products. So I don't think that we will see a total differentiation of the market. We will see relevant players everywhere. And we, as a global supplier with a global supply base in the world, will be happy to support our customers worldwide.
Do you think we're going to see a different speed in terms of the move towards autonomy? China feels like it's moving maybe much more aggressively. Western markets feel, again, more cautious when it comes to autonomy. Do you think when it comes to autonomous driving, where is the leadership currently?
I think this is also a difficult question to answer, like in a very broad and general way. When we look at autonomous driving, for example, and we've spoken about the project quite openly already, we are working together with Aurora to bring fully automated driving trucks to US roads already in 2027. I think this will be a great achievement and a great approach, and the business case is also very attractive for our customers to go into this direction. The technical design is more or less done by now, and we now already have trucks on the road driving and testing, and I'm very positive that this will be a big step forward, especially on the truck side, and this will take place in the US market.
Katja, before we let you go, can you give us an update on potential divestment plans? I know this is something you and the team have been scrutinising. Anything on that front, and any updates on what more you can do on the cost front?
So I think in principle there are no special updates. We have announced at the Capital Market Day that we do legal carve-outs for two major businesses in Continental at the moment. One is our user experience business on Automotive. The other one is our original equipment solutions business in ContiTech. Both carve-outs are running according to plan, and we will take decisions on the strategic next steps as soon as we are ready to do so, and then we will also communicate it to the market. On the cost side, I think we've been very vocal at the Capital Markets Day, but also later on this year, that we are doing a lot to improve our operational excellence in that arena, getting down administrative costs, also improving the R&D efficiency. Both programs are running according to plan, and we will also expect to see first impacts already in the second half of this year.
Katja, thank you very much indeed for the time. We really greatly appreciate it. Continental CFO Katja Garcia-Villa, thank you very much indeed. I want to take you back to the rate story. The Riksbank, first rate cut since 2016. It was at 4%. It's now at 3.75. Let's talk about also the fact that the Riksbank seems to be committing or expecting to be cutting rates twice more in the second half of this year. Matthias Persson, Chief Economist and Global Head of Macro Research at Swedbank, is the perfect person to talk to about this. Matthias, you're probably not surprised that we're seeing the rate cut, but I'm wondering what your reaction is to the fact that the Riksbank is committing to two more rate cuts this year.
I think it was a great decision by the Executive Board and the Riksbank to actually lower policy rate. We have had that in our call for some time. And I'm not surprised, actually, that they are saying that there will be two more rate cuts this year if inflation developments is going according to plan. That was communicated already in the last monetary policy report, and they have changed the way they communicate. They have decided to stick much more to the short term, and in particular, that included 3 rate cuts this year. We actually think there will be one more, but I think it was a good decision, and then I think it's good that they signal very clearly how they see the developments going forward.
Yeah. Why is this central bank able to deliver that level of certainty and that degree of rate cutting when other central banks, the Fed in particular, but to a certain extent the ECB, the Bank of England as well, are being much more cautious?
I think monetary policy and the lack of monetary policy is much faster and much stronger in Sweden. As you know, we have a lot of debt in the private sector, in particular for mortgages. And most of us like variable mortgage rates. And that means that monetary policy has a big impact and very quick impact. So if you look at the inflation trend since January this year, it has been completely different from the developments in the US and in Euro area. Much sharper and quicker turnaround, and inflation coming down much faster. So I think monetary policy, the lags, all of that is important. And monetary policy has a bigger impact in Sweden than compared to the US or Euro area, for example.
And yeah, you're very optimistic about the Swedish economy. How much faster do you expect it to grow than the rest of Europe?
Yeah, in particular next year. So we think that in midsummer, which will be end of June this year, from that, we expect consumption to gradually increase. Next year, we will have expansionary fiscal policy as well. Remember, we have a very low debt to GDP for Sweden. It's roughly above 30%. The Minister of Finance has been very clear. She will be much more expansionary with tax cuts next year. And together with more cuts from the central bank, we expect the Swedish economy to grow 3% almost next year, double the growth rate that we have for the Euro area. And that also speaks in favor of the Swedish krona strengthening going forward.
But you have seen the krona dropping off the back of this decision to cut and the guidance for 2 more cuts this year. How worried are you about krona weakness feeding into the inflation story again?
I'm not super worried about that, actually. When we looked at our forecast for inflation, and we are more worried that inflation is actually going to be below the target from summer and onwards. And actually, you know, the krona needs to be at roughly 11.85 to the euro for the average of next year in overall in our forecast for inflation to be at the target. So I'm much more concerned looking forward that inflation will actually undershoot.
Mattis, I'm still stuck on your debt to GDP data point. I didn't know that about Sweden. 30% debt to GDP. That's pretty enviable, isn't it? Sitting here in the UK with 85% or thereabouts. Mattis, so that's really interesting in terms of the fiscal impulse that could come through for Sweden next year and that 3% picture you see on growth. When it comes to the real estate market that we know has struggled in this higher rate environment with the debt load there, what that means for households, are we past? Is that it then? Can we put that in the rear view mirror, given that rates are going lower?
It's starting to improve already. Actually, we have seen flats and houses already starting to increase slightly. We expect house prices to be at the bottom and actually grow some 2 to 3% this year with house price going up. Next year, we expect 5%. So activity has picked up. If we then turn to commercial real estate, which has also been on international media, we have not been as concerned for that being a financial stability risk for the Swedish economy. Yes, there has been concern for individual companies, but not for the market as a whole. So I think with this cut, we will see a turnaround and improvements both for commercial real estate and also for the housing market. So yes, it is turning around.
If the Fed doesn't cut this year, is this decision going to come back to bite them?
No, I don't think so. But I think Fed will impact both the Riksbank and the ECB. But it's more on how many cuts we will see and how gradual and when we will see the cuts. So we are thinking about the Riksbank. We think September, probably the next cut. They want to see what ECB is doing, probably also what's happening with the Fed. And then we have late cuts for the Riksbank this year, so November, December. And hopefully we think that the Riksbank will have some more clarity when it comes to both the ECB and the Federal Reserve at that time.
Mattias, what does this mean for Swedish industry? We spent a lot of this morning talking about German industry and the fact that it is struggling right now. Many of the German industrials that we're talking to are talking about a recovery in the second half. To a certain extent, that feels premised on the idea that we're going to see rate cuts from the ECB. If we see rate cuts coming through from the Riksbank, is that an early test about how Swedish industry is going to recover? What do you expect to see in terms of the industrial numbers?
That's a good question. I think we have had a two-tiered system here in Sweden. So the domestic market, retail, everything oriented to the Swedish domestic market has been struggling. You know, durable goods, cars, boats, all of that. But our export sector has actually been growing all of that, probably helped by the weak krona, but also the fact that we have some good producers that produce goods that have a great demand still. You know, think about greening of the economy. We have some good export-oriented companies in that. Of course, also in defense. And if you look at what is the most important export market for the Swedish economy right now, it is actually the U.S., both for services and goods. So with U.S. growing above expectation, that has also supported the Swedish economy. So I'm quite optimistic now that the domestic market, with this first rate cut, more to come, and also, you know, what should be remembered is that inflation coming down is very important. It means that real wages will increase, so consumers can feel a bit more wealthy, and that's why we think that the domestic market also gonna take off.
Okay, so a bright picture in terms of the order outlook as well, the demand outlook for some of those key import nations, the US, of these Swedish goods. Does Sweden have the labour force to match that demand?
That's a very good question. I think, you know, the labour market is tight in Sweden. Even if we have seen some weakness in the labour market and we expect labour market to deteriorate somewhat more during this year, I think what we hear, meeting customers and also from service being done on Swedish economy, corporates are hoarding the labour. So I am a bit concerned, maybe not for this year, but maybe more long term. I think there will be more infrastructure investments and so on in Sweden, partly because of NATO and also other defense investments that probably needs to be done. There, I think maybe we need to think about the labor. So we need to do much more for improving the functioning of the Swedish labor market.
OK, Matthias Persson, Chief Economist at Swedbank. Great to have you on the programme. Of course, you were one of the people who predicted that cut that came today. Not everybody did, but not everybody indeed saw the expectation of 2 more cuts telegraphed from the Riksbank this morning. We thank you for joining us. But it's not the only thing that's on the agenda today. There's plenty more to look out for. At 12 p.m. London time, US MBA mortgage approvals are on the docket. Then at 5:30 p.m. London time, it's Brazil's monetary policy decision. Brazil's central bank has become, of course, increasingly dovish under Lula. Then at 6 p.m. UK time, we have a US 10-year auction of $42 billion. And we have China's President Xi Jinping continuing his trip in Europe, as we were discussing. Then later we have US earnings including Arm, Uber, Airbnb and Robinhood. And finally, through the day, we have central bank policymakers chipping in with their thoughts from the ECB and the Fed at various different events.
The market's turned around a little bit. Up 0.3%. Guy's not convinced, but you're seeing the gains there. Up 3% on the European stock 600. Even the US futures are edging into positive territory. And given that we've had 4 straight days of gains for S&P, maybe that's not something to be sniffed at. It's borderline, of course, in terms of the US story and the futures picture. But you're seeing a little bit of upside, Guy.
Keep it on the 5,200 level. So yesterday it turned out to be a really big line in the sand for the S&P. I think if you can break through that convincingly, it'll be interesting to see where the markets go. But if it turns out to be a ceiling, that could be quite interesting.
5,200 as a floor or as a ceiling for the S&P.
We'll see. We'll see how the market trades around that. We're going to go away. We're going to have a coffee. Lizzie's going to go away. Write extensive notes on the Bank of England for tomorrow.
That's true.
That's a big one. I mean, let's not talk more about Sweden. I think we've done that one justice. But we can move from the Riksbank then to the BOE and set us out.
Confidence?
Well, exactly.
What do you think?
Is that kind of move factored in?
SMB, Riksbank. Could the BOE be next? At least could we see more dovish voters this time? Dave Ramsden, I'm looking at you.
OK, so what do you think? Do you think it turns more dovish? The inflation story here still feels much more sticky than it feels like it is elsewhere. And the government, in so many ways, is aiding and abetting that by pushing up the minimum wage, all these kind of other factors. You look at what's happening in the service sector, feels still sticky, the story there.
Depends which data you look at. As I say, you've got that hawkish triumvirate at the end, but really look at the dovish end to see whether you get more. That could be a signal for the future if they don't cut this time. OK. That's for tomorrow. What else have we got coming up? We've got Wayne Griffiths, the CEO of SEAT, coming up. Looking forward to that conversation. And Demis Hassabis, the CEO of DeepMind. That is a conversation I'm looking forward to hearing. Tom's already done that interview. I'm very much looking forward to it playing out at 4 p.m. All of that is coming up here on Bloomberg. I'm going to hand you over to Francine Lacroix. The Pulse is next. This is Bloomberg.